Hey guys, what's going on? This is Kyle at ProjectionHub, and I am back with another SBA approved business plan video. So in today's video, I'm gonna walk you through a real business plan that we worked on at ProjectionHub, and it got approved for an SBA loan here recently. It's an acquisition, which is a little different than the other two that we've done so far. So I'm gonna walk you through the business plan, as well as highlight the kind of 6 or 7 key components or ingredients that I think got this one approved, got this one across the finish line as far as SBA is concerned. So when we do these videos, I try to balance both. I try to give you a real example of a good business plan, the components of it, how things look, some things you can kind of implement in your business plan, but also if the goal of the business plan is to get approved for an SBA loan, there are some different things and some different variables at play that may not necessarily, be solved exactly by the business plan, but they're kind of a part of the sauce here. So talking about those. I guess I should mention, if this is your first time seeing one of our videos, my name is Kyle Fawcett. I lead the business plan writing services at ProjectionHub, where we help startups, existing businesses, and acquisitions secure SBA loans by helping them with financial projections and writing business plans. So I was an SBA loan officer for about 7 years before I started writing business plans with ProjectionHub. So that's kind of a quick backstory, and yeah, let's go ahead and jump into this. So here we go. We got, a nice little custom cover photo here. Now, obviously you can see that this is not only an acquisition, but it's a franchise acquisition. And that does a lot of heavy lifting in this situation. And we're going to talk about that more as we go. But a little bit of the backstory here. The owner was looking to purchase this operating UPS store, but it had been kind of underperforming in recent years, mainly because the owner that had been operating it for a long time had sadly passed away. And so the business was kind of limping along, I think being owned by the former owner's spouse or widow, was trying to keep the business going, but there just was a lack of focus on their lack of just kind of investment in the business. And so the business's performance began to deteriorate over time, which can cause some challenges in the SBA. So we'll get into that a little bit as well. But yeah, just like normal when we go through this, we're going to kind of walk through the business plan. You can see the structure. Whenever we work on a business plan, they follow a relatively similar structure. That might change a little bit from an acquisition versus a startup, but try to cover the same amount of ground with a few different caveats. So executive summary, giving a nice background of what's going on here, but a big component for executive summaries that I like to incorporate that some people don't. And that's really focusing on why the owner is equipped to do this, the buyer. So let's keep that in mind. Whenever we're talking about the owner, we're talking about the buyer. That's who's writing this business plan. And so one of our kind of 6 or 7 key ingredients for getting approved for an SBA loan is having relevant background or direct relevant experience in this type of industry. And actually in this case, the person who was trying to buy this business didn't have a ton of relevant experience. And so you might be scratching your head like, well, that doesn't make a lot of sense. You've talked in a bunch of your videos about why that's so important, which is true, but that's why the fact that this is a franchise does so much of the heavy lifting. So lenders really like franchise deals. And a lot of that is because franchises have lots of built-in systems. They have lots of built-in marketing support. They have lots of built-in, employee training programs. They have a lot of built-in brand recognition. So like the UPS store is a very highly well-known brand across the US. UPS stores have been around for a long time. So UPS stores are pretty highly sought after franchise because they have a pretty high success rate. They're pretty low overhead. They're kind of hard to mess up the operations. And everybody kind of knows about the UPS. And so they tend to perform pretty well. So in this case, this is like the perfect type of acquisition for someone who's looking to buy a business that may not have a ton of experience in owning a business or managing a business. And so that kind of offsets in this case. If she was trying to open a brand new business, so that's 2 things here, an acquisition and a franchise acquisition that has a lot of guardrails on it because of the franchise that it is. That's kind of the perfect setup for this buyer that doesn't have a lot of experience in managing a business. So that's one thing to keep in mind is the franchise, and specifically this type of franchise is kind of canceling out the owner relevant background. Now there's still components of that, right? Some transferable skills and whatnot, but as far as direct industry experience, they didn't really have any. So if you're out there and you're thinking about like, wow, I would love to start a business or, buy a business, but I don't have a ton of hands-on experience, consider looking into franchises. That's something that lenders can still get excited about because they have a lot of trust and confidence in the franchise component. So kind of moving through here, again, this isn't something that's typically included in a business plan, but one of our really important key components here is the personal financial and credit standing of the applicant. So in this case, the buyer had solid personal credit. And a big component too is that they had some outside income. So that's a very strong thing for an applicant, is if you can say like, hey, I have this income over here that is not going to be impacted by whatever happens in this business. Because why that's important is the business doesn't need to support the buyer. So the lender knows that the owner itself and them compensating themselves and all of that kind of stuff isn't going to take away from the transition that needs to happen in the success of the business. So this person could say, hey, my bills are covered. I can take care of my family, do all of that stuff in the business, and then let the money stay in the business and kind of let this thing grow and make sure it's doing what it needs to. So that's why outside income can be a really strong component. Some lenders might say, well, if you have strong outside income, that can help repay the loan. That's not quite as important as just the fact that you're not going to be as much of a burden personally on the business's financial situation. So that's kind of their personal situation that was in a good spot. If you're out there and you're saying, I don't have outside income, or what are examples of helping with that? So like a cosigner. Right. So if you have a spouse that has a full-time job, having them as a cosigner. If you have a parent who has their own, thing going on, they're willing to be a cosigner on a loan. Those are examples of adding outside income strength to a deal like this. Okay, continuing to move along, you can see, again, the purchase price of the business was around $400,000. And so they were seeking an SBA loan for that amount. Now it needed a lot of upgrades and investment and things like that. So, the owner was going to be investing cash into the business as well. Just to remind you, you're going to be expected to invest 10 to 20% of the project cost personally. Now there are nuances to that, especially when you're looking at an acquisition, like the seller selling part of the business. Do you want a seller's note? Because a portion of that can be counted towards your owner investment, but only like 5% of the owner equity. So there's some different details to that. But just in this case, it was a $400,000 asking price. And again, a larger that was because the business was, you can see right here, the business generated approximately $800,000 in revenue over the last 12 months. So you might be thinking like, wow, why are they only selling for $400,000? But you can see that right here, only $25,000 in profit under the previous ownership. So there's some work to be done here. This is like a project that's being bought. There needs to be a turnaround here. So another kind of key point here is demonstrating the plan for the business. So I could jump ahead a little bit, but down to our transition plan here, talking about the strategy of the business being changed, the improvements being made, an operational roadmap, because a big component of getting this one approved is making sure that the lenders believe in the ability to turn it around. So, many people out there think a lender is going to like the idea of finding a really underperforming business and then helping them buy it and then turning it around. And that's really not the case. Think about it as like a fixer-upper house. Most banks, like a normal lending bank, isn't going to be stoked if you come in and say, hey, I found this rundown house for $100,000. I want to buy it. Give me a couple $100,000 more and I'll fix it up and then I'll sell it for $1 million. There's a reason there's very specific lenders and investors out there that like those kinds of projects, but not traditional lenders. It's kind of a similar case when looking at a business. SBA lenders especially don't really like lending to projects like that. If the business has been losing money, it's not cash flowing, debt service coverage ratio is off, that's not really something they get excited about. So there needs to be a very clear plan and a very realistic and believable way that can be turned around. And so in this case, there was historical precedence in the financials that showed like, hey, the business, you can see this trend here, 950,000, 930,000, 940,000, boom, down to 863,000. And that was around the time the owner had passed. So there's a very clear change in how things were going there. With a very easy way to kind of turn that around. And the buyer didn't need to pay themselves right out of the gate. So that is a pretty clear path there. Okay, so looking at my checklist, we talked about personal credit and standing, talked about the relevant experience with the franchise offset. Another one, let's jump to the financials. I said here, having a realistic and believable financial projections and cash flow, debt service coverage ratio of 1.25 or higher. So we already talked about, in an acquisition, you have some historical financials to go off of, and the projections need to demonstrate a realistic, where are you going to go from here? If you're buying a business that's already performing really well, your projections shouldn't show a dramatic change. It should be very subtle. You should be focused more on stabilizing things and steady, modest growth In a turnaround project, probably needs to be a little bit more dramatic than that, but not crazy, right? So you can see here projecting 882,000 to 909,000. So kind of a build up back to what it was over the course of 2 or 3 years and doing it that way. So let's see if we have, usually when we get into things like debt service coverage ratio, a lot of times we will keep that outside of the business plan and just talk about that with the lender, because that's kind of subject to what they agree for add backs for sellers' discretionary earning. And it's a little bit of a moving target for different lenders. But debt service coverage ratio, we want to see that at 1.25 or higher. That number basically means the business is generating $1.25 of positive cash flow for every $1 of debt. So we need to make sure that the business can continue operating and take on that loan debt. And there's a nice buffer there. If it's like 1-to-1, there's no money, right? There's no margin there for anything. So if it dips below, you're not able to make the loan payment. The business isn't able to cover its bills. So that's why they want to see it that number. Okay, going through our other plans here. So 2 of the key points that are usually in the business plan that I like to talk about are proof of demand and customer acquisition plan. So proof of demand would be market analysis. So jumping up to our market analysis section, we talked about the U.S. retail logistics market is still growing like crazy. Consumerism and consumer packaged goods and different things like that are still going high. There's also a huge increase in people starting their own businesses from home, selling things on Etsy, selling things on eBay. Like a lot of people are utilizing UPS stores for things like that. And so there's pretty significant growth in people using services like this. And even looking locally to where their store is located, there's a very positive trend in Google search data for people saying like, where is a UPS store or UPS store near me? We can see a pretty positive growth there. So people are seeking out the store, and growing demand for that was supportive of that. And then customer acquisition and traction, like if this was a startup, we need to have a pretty nailed down plan of like, how are we going to even find our first customers? How are we going to get them in the door? And I'm not talking just like have a website, run some advertising. It's like even a little bit more believable than that. But given that this is an acquisition, part of that is kind of baked in, right? The people in the town know this exists. They already have a customer base. It's a lot more about reestablishing. There's new management, there's new ownership, giving people good experience, banking in more positive reviews, being active in the community, making sure people know things are different. So it's a different strategy when trying to demonstrate that for an acquisition. And I think that was done well in their transition plan and talking about a nice handoff and retaining the existing employees. That was a really big component here, is they were going to keep on the employees there. So there's that familiarity. And let's see here. We talked about the demonstrated transition plan. So yeah, we've pretty much covered the whole structure. I know we jumped around a little bit, but in a nutshell, this one did ultimately get approved. Its strengths, again, were she had that personal outside income. So that was a big bonus point. It's a franchise acquisition, which lenders really like because franchises are standardized in a way. So there's not as many surprises when it comes to the operations and the transition involved. So lenders really like that. Some of the tough components, obviously, was she didn't have direct personal experience, but enough that it would work within the franchise system, and that the business historically had a rough year or two of performance because of the previous seller, passing unexpectedly. So we really need to make sure the plan and the projections gave a realistic and believable plan towards turning things around. And that was a big component of this one. So yeah, that's kind of the ingredients of what this business plan helped get accomplished. So if you're out there and you have questions, like if you're writing a business plan or you're thinking about starting or buying a business and you're not quite sure how to approach writing the business plan, please feel free to reach out to us. I offer a free business plan review, so you can go on our website, submit your business plan, and I can take a look at it and give you some feedback. We also offer a free SBA review. So if you go to our website, ProjectionHub.com, you go to SBA loans, you can see our free SBA expert review, and you just fill out a little form. And usually our owner, Adam, who has even more SBA lending experience than I do, he'll review your situation and kind of give you direct feedback on what he thinks your approval odds are going to be, some recommendations, a heads up on potential red flags for your application, even recommending some lenders. And that's one thing that I failed to mention in this that is a key component in the SBA kind of approval process, and that is just using the right lender, finding the right lender. And unfortunately, like with you sitting out there, you might be like, well, how do I know who's the right lender? This is a very specific, like kind of niche loan application, and every loan application kind of has a unique story, just like we talked about with this one. And sometimes it means like working with someone that knows the right lenders. We do have a free, not to keep throwing free resources at you, but we have a free SBA lender finder tool that can help you kind of find what lenders might be best for your type of industry in your state. But it has limitations. You're not going to go in there and put in like who's the best lender for UPS store acquisition. So you got to be a little more conservative around that, but it can help you get to the right point. But part of that free SBA review is if we think we know of a lender that might be helpful or a potential good fit for your situation, we're happy to make an introduction and help you in that process. So yeah, hopefully this video was helpful. Again, if you have questions about your business plan, navigating the SBA process, finding a lender, any of that, don't hesitate to reach out to us. We'd be happy to help. And we'll see you in the next one. Thanks.